everyone, and welcome to our DAT IQ weekly market update. We're back after the holiday weekend. This is our update for June 8th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who is our Principal Data Scientist. Welcome, guys.
Howdy.
Hey, good morning.
How'd you guys enjoy the week off?
It was nice, I do love doing the show, though. It's a lot of fun to be able to hear all the latest freight news, but child management is a lot easier when I don't have to try and run to the studio real quick.
That's funny. Dean and I are under a heat wave right now. I don't know what's going on in Oregon, but the Midwest and up in New England's dealing with like 90s, unseasonably warm.
That was last week for us. Last week for us was in the 90s. It got up to like 95 or something, and I had to haul out the window units. But now we're back to like a more normal Oregon temperature.
Nice. So for those not familiar, we're here pretty much every week. Last week was the exception, talking about the freight market, trends, what we're seeing, and helping you make better business decisions. In that vein, if you have any questions, we save those for the end of the show, but we encourage you to get them in early. Just drop them in the chat or comment section, and one of our illustrious marketing team members will forward them over to us behind the scenes for the end of the show. So with that, I'm going to dive right into the key trends for this week. So load and equipment posts were both down. Dean's going to talk extensively about some of the what we would call like traditionally conflicting market indicators and why, if you think about it a certain way, it does all stitch together and make sense. Spot rates up for dry van and reefer, but flatbed, much to its name, remaining a bit flat. And then capacities tightening as drivers are harder to find. We have the seasonal pressure as we head into the 4th of July. These next few weeks are typically some of the busiest of the year, especially excluding retail peak. So it'll be really interesting to see what happens, and then also tracking if we get that sort of post-Independence Day lull. So with that, I'll turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. Interesting week. Short work week, of course, but volumes have been, on the downslide for about 3 or 4 weeks. We'll have to wait till next week to see if volumes are declining overall. But Roadcheck Week was a few weeks ago, and volumes have been on the slide since then. They're down 34% since that Roadcheck Week in early May. Equipment posts also dropped last week, I suspect, as carriers took some time off. So the net effect on the load to truck ratio was a slight drop to 4.77 loads per truck in dry van. Similar story in refrigerated after the massive week and the big surge in volume leading up to Memorial Day. 22% fewer load posts last week, fewer truck posts. So the load to truck ratio dropped to 8.53, down about 20% week over week. And in flatbed, volumes were down also again last week. They were down by about 18%, but that's down for the 5th week in a row. Fewer carriers on the road, so the combined effect was the load to truck ratio decreased slightly by about 10% to 79.94. Not a big change, but we'll wait to see if any of those numbers bounce back next week as a result of this week's full 5-day shipping week. Moving over to the market condition index, very little change in average spot rates in the top 10 markets last week in dry van. They stayed around 262 a mile, excluding fuel. Focus this week is really on the West Coast. Capacity there is very, very tight. East Coast markets, capacity seemed to loosen a little bit on lower volumes, but was the opposite was the case on the West Coast. And of course, we've still got record volumes of containers flooding in from Asia. We've got all sorts of spikiness in the volumes, massive amounts of container volumes some days, none others. Of course, we've got now a big 12-day delay on vessels loading out of the Shenzhen port due to the COVID outbreak in South China. That's going to cause more chaos on the West Coast spot markets as retailers try to bring more inventory in. In Los Angeles, load post volumes were down about 17%, but rates up 1 cent to 3.07. Ontario nearby, rates are up 3 cents a mile to 3.21. Again, on decreased volumes. Los Angeles to Chicago, that's a big truckload versus intermodal competitive lane. Rates are up 87 cents a mile since January at the start of this year. running at 277 a mile on that 2,000-mile haul. Atlanta to Chicago rates are up also to 232. That's up 88 cents a mile since the start of this year. So having a look at the refrigerated market condition index, similar story, lots of tight capacity on the West Coast. Of course, it's a big produce market. Nearly 60% of all of our fruit and veg comes from California markets. In Los Angeles and Ontario, rates are up 9 cents a mile and 4 cents a mile, respectively. Los Angeles outbound reefer rates are up around 357 and a little bit higher in Ontario at 366. And of course, this week marks the end of the cherry season in Lodi, California, in the Stockton market. And rates on the 800-mile run north to Seattle are up at $4.41 a mile, excluding fuel today. That's up $1.60 a mile since February. In the flatbed market, capacity doesn't appear to be easing in the flatbed sector, even though volumes have decreased for the 5th week in a row now. Capacity was noticeably tighter in Memphis. Rates are up 16 cents a mile to 383 last week. That's excluding fuel. And in the second largest flatbed market in Houston, there was no change in capacity as spot rates stayed around 287 a mile. So wrapping up with our year-over-year look at spot rates. And before we dive into that, some of you have already commented that we've changed the way that we look at spot rates in terms of how we narrate them each week in our weekly market update. Rather than pull the data on a Monday morning and then look at the daily rates over a week, that includes all of the volatility of a weekend. So there's lots of spikes, particularly in the reefer section over the weekend. So what we've elected to do is change the way that we look at spot rate movement week over week by building an average from the day of pickup in that prior week. And then that gives us a better view of how rates average out over the course of the normal 5-day work week and smooths out some of that volatility we see on a weekend. So with that said, spot market volumes are down, as we said earlier. Spot rates moved up 4 cents a mile last week to 239 over the course of the shorter working week. So they're still 83 cents a mile higher than this time last year and about 43 cents a mile higher than 2018. Capacity tightened in refrigerated also. Spot rates are up 2 cents a mile over the course of the week to 276 average to all destinations. That's excluding fuel. Still at record high levels, 85 cents a mile higher than this time last year. We're just coming out of that big trough that we saw in May last year when the economy closed down. So our year-over-year comps will start to improve once we get into June and July. And in flatbed, rates are definitely plateauing around 269 a mile, 269 per mile. They moved up last week just less than 1 cent a mile, so it wasn't a big change last week. Still 87 cents a mile higher than the same time last year and about 30 cents a mile higher than some of those records we saw during that flatbed rate rally in 2018. So that's it for this week's market update. If you'd like to find out more and read our written report, go to dat.com/market update and download our weekly freight market update. That's it. Over to you, Ned, for the short-term forecast.
Howdy, everybody. We're going to be starting off our short-term forecast by looking at vans, and you can see that there's a little bit of model divergence here. So to get into the details, in blue is the market rates observed by DAT, and then off to the right, you can see our 4 different models that we're talking about this time. Ratecast, our flagship model, in green, the short-term model in red, and blended forecasts, which are mixtures of the 2 models in different amounts and in different ways in gold and silver. You can see that Ratecast is expecting there to be the sort of normal seasonal pattern of heading up until the 4th of July, peaking around then, and then heading down afterwards, whereas the short-term model is still expecting a bump around the 4th of July, but it's seeing a little bit of a cooling trend in rates, and it's projecting that forward with that one little bump as we move into the 4th of July. And the 2 blended forecasts are kind of straddling that middle there. The gold forecast tending a little bit more towards the Ratecast model, and the silver forecast tending a little bit more towards the short-term model. Moving on to reefers. You can see once again in blue the market rates observed by DAT, and here there's a lot more model agreement. There's a lot of wiggliness that we're seeing as we're heading into the 4th of July season, but there's a large model agreement that things are heading up and to the right, and then there's a little bit of disagreement about how much of a spike we should be expecting heading into 4th of July. With the short-term model expecting a really big spike, and the Ratecast model expecting some spike, but much less pronounced. Ratecast is also expecting the trend to maybe break a little bit and start heading down, but that's when we start to move past the 4th of July, but that's going to be interesting to see exactly how that plays out. Finally, moving into Flatbed. Flatbed is interesting because we have a lot of model agreement, but all the models have kind of changed their tune, at least a little bit. In blue is the market rate observed by DAT. Off to the right, we can see in red the short-term model, in green the ratecast model, and in gold and silver the blended forecasts. That is, if you have very sharp eyes, you can see all of those. For me, it looks kind of like a big color smudge, which is a sign that all the models are more or less in agreement, with a little bit of disagreement once again heading into 4th of July. I think that the short-term model is, again, predicting kind of a big bump around 4th of July, whereas ratecast kind of smooths that out a little bit. As just sort of before and after. Ratecast is also expecting rates to start heading slightly downwards as we move into the post 4th of July period, as is the sort of standard seasonal pattern. That's about it for the forecast, and then we are ready for the Ask IQ question of the week, which, let me get the exact wording on that because it's pretty interesting. What impact will recent driver pay increases have on the spot market in the second half of 2021?
And beyond.
And beyond.
Right. Yeah.
Dean?
Yeah. I was thinking about this morning. Drivers were generally, I remember a book that was written by Professor Michael Belzler called Sweatshop on Wheels back in the 80s. And it was kind of fascinating because having driven trucks for a few million miles in my life, drivers generally feel underpaid for everything they do. And it's more so prevalent in the post-ELD environment because time is money. And it's hard to play catch up when you have delays with ELDs. And of course, every hour you sit on a loading dock, you're not getting paid. That translates into about $25 an hour of opportunity costs for a driver. And not all drivers get paid for the time. So I think one of the biggest frustrations drivers have got these days is the time they spend and generally lack of appreciation. So when it comes to pay, it's not just about gross earnings. It's about more. When I talk to drivers, it's more about consistency of pay. It's the peaks and valleys that really hurt. Because if you have higher miles one week and none the next, you have layovers some weeks you're busy. That changes your week-to-week gross pay, and it's very hard for families to budget accordingly. So what we see is pretty good correlation between fleets that have time-based salary models where they pay annual pays. A little bit opposed in the industry because of the way the pricing models are based, but generally in the last 6 months, I've seen nothing but big fleets looking to increase their pay rates in the range of 25%. Common theme when you read all of the news about pay rates is comments like largest pay increase in history. I haven't seen those sorts of comments, consistency loss across all the big truckload carriers for a while. Some fleets have got drivers up around $50,000 a year as an entry starting point. Salary increases have generally been in the 12 to 14% range over the last 6 months. Flatbed carriers starting at 47 cents a mile. That's like 47 grand a year if you're running 100,000 miles. And the thing that struck me in the flatbed sector, because they've got so much tight capacity, flatbed carriers looking to pay drivers that are experienced as high as 63 cents a mile. And TARP pay doubling from $50 to $100 a load. 16 cents a mile more for over-dimensional loads, 6 cents a mile more for hazmat and Canada loads. So all sorts of incentives being offered for fleets to get drivers back into the industry. And I think next week we'll have some good data on how long the lag is between when pay increases start and when drivers return to the industry in meaningful numbers. There's no sign yet that that's actually happening, but it's certainly in a meaningful way because capacity is still really tight. Drivers are still really hard to come by.
Yeah, I mean, I think the big question, right, Dean, is it going to continue? We saw some of the large employee fleets do 1 or 2 driver pay increases and up their sign-on bonuses in 20.
Yep.
The ones that maybe did 1 driver pay increase in 20 have already either announced or there's rumblings about 1 in 21. We're seeing increased accessorial charges coming out in bulletins from some of the large asset-based carriers, right?
Yep.
Usually, I mean, a lot of that accessorial pay, especially if it's a contract fleet, is passed along as a percentage to the driver. That's going to be more difficult. I mean, typically, you don't claw back those driver pay increases, correct? I mean, you only sort of, it's either goes up or stays flat. So that should, and maybe I'll turn to Ned on this one as a segue, that should pivot to higher contract rates down the road, wouldn't you imagine?
I would imagine that it would. I mean, there's only so many places, putting aside like large macroeconomic weirdness, either people are going to have to accept lower margins to meet with those pay increases, and I don't imagine that people are going to be really happy to do that, at least especially in terms of like a long-term perspective, or they're going to have to increase contract rates. So,
the challenge the industry, Scott, is that I would say to you from a driver's perspective, drivers have been underpaid for quite a long time not because of the driving part. It's all the non-driving things that eat up your time. If you look at the average hours of service numbers that drivers run typically in the over-the-road sector, it's capping out at around 7.25 hours a day. So if you've got a theoretical maximum of 11, which is pretty hard to hit, you've got to have a really good day to bump up on 11 hours of total driving time and, somewhere up around that 650, 700 mile mark. A normal day is like around 450 to 500 miles, and that's pretty good going depending on traffic and weather and all sorts of delays. So drivers don't really get all of the productivity out of the day that they can. Some do it deliberately. They deliberately pull over to find a parking space because parking spaces are in short demand. So a lot of newer drivers in the industry trade off rolling time with finding a parking spot earlier in the day, and that hurts fleets' productivity. I think smaller fleets generally have a better go at it. The drivers seem to be more tenured and have more of a fixed 5 and 2 schedule, 5 out, 2 home. So there's always this need to get back home for the weekend. So there's a lot more consistency in their work volume. But it's generally a really tough industry. I mean, paying drivers more now, I think, is really just getting them back to where they need to be in terms of all of the things that go on, because we've got lots of non-driving time where that accessorial pay now starts to help bring drivers back to a salary range that makes it, a good wage for what you do. And when I say that, I mean, you're away from home for a long time, right? When you drive a truck, doesn't matter whether you work regionally, you can be away from your family for 5 days without too much effort. And it's a hard lifestyle. It really grinds on you over time. So pay certainly needs to increase and be commensurate with what drivers really go through.
I mean, I don't really disagree from the fairness and equity perspective, but I will say that, to echo Ken's point, it's going to be really hard to claw these back. And I think one of the questions is going to be, given how high rates are right now, there are maybe some signs that they're heading down, but if you've raised driver pay and rates start falling, what's that going to do to a lot of the people who are caught in the middle there?
I think that just adds momentum back to the contract market, right? Most of the driver, the vast minority of freight, the minority of freight that's being hauled by these employee fleets is spot, right? Their bread and butter is contract.
Correct.
So I think that will manifest itself in a rush back to the contracted loads eventually. The big question is when.
Right.
I was talking to Chris Kaplis and Enom a bit, and there's a pretty linear long-term trend when you normalize out some of the bumps of that 3 to 4% annual contract rate inflation. There's a lot of talk right now in the industry and amongst analysts about whether that's we're going to see an inflection in that going forward as a result of this.
Yeah.
I know, coming from the industry, driver pay discussions are met with a lot of strife, very much because there's no putting that toothpaste back in the tube, generally speaking. Yeah. So I don't think companies are taking these conversations lightly, and I do think of all of this, that will be the longest term ramification to come out of this. Because to your point, Ned, spot rates will go back. Just much like floodwaters, right? When they recede, there's some lasting damage, but once it's all cleaned up, you sort of forget. I think on the contract side, there could be some long-term ramifications that, shake out of all this.
And Ken, remember, on our show about, I think it was 6 months ago, we talked about tightening capacity on the driver supply side. And we kind of theorized that the capacity is going to be much tighter in the long-haul truckload sector, as opposed to the short-haul regional operator where they're closer to home and there's more competition for, there's more demand for drivers to deliver a lot of this e-commerce freight that we've seen over the last 12 months. So what's panned out is that truckload capacity is, in terms of driver supply, is very tight in the long-distance truckload sector, which is the hardest part of the industry where drivers typically enter. You know, it's a long-haul trucking, especially in the student fleets, is typically a starting point for a lot of drivers in their career, because they get a training school. They can go from zero experience to driving an 18-wheeler in a matter of weeks, albeit with a mentor buddy system. So that's an easier way to get into the industry, but it's also the hardest part of the industry, and entry-level jobs are typically not paid very well, especially fleets that pay drivers sort of a minimum guarantee of $400 or $500 a week for the first month. You know, it's not a lot of money when you are entering into a new career, and most likely, based on my experience with drivers, coming from a lot of financial stress at home as you transition into truck driving. And then on top of that, you've got to go through the sleep deprivation, because you go from sleeping nights to suddenly no sleep at all, or at best sleeping in different times of the day. And it puts enormous stress on the body. And it's hard to articulate how hard that is for drivers, but there's no coincidence that peak driver turnover is around the 90-day mark. And after 90 days of going from zero to working, not working in a truck to driving a truck and being all over the country and all sorts of traffic and weather, it really wears you out quickly. So the industry's got to do a couple of things. One is just increase pay, but do a better job at transitioning drivers from drivers to career professionals. There's a massive void in between the two. And the industry typically doesn't do a great job at transitioning people into the career aspect of this, because that short-term 90-day turnover bump is very hard for fleets to get over. It becomes a numbers game.
Before we go on to listener questions, I do have one question that I want to ask for you, Dean. And that one of the things you said is that for a lot of drivers, the most important thing isn't as much the rate of pay as it is having a smooth and predictable amount of pay.
Yep.
Is there, in your opinion, a way to change the pay model to maybe get away with, or not necessarily get away with, but reduce the pay increases somewhat, but give people what they want more than just a higher base pay?
Yeah, it's an evolving model that's been around for a couple of years now. Companies that are already paying drivers annual salaries have a far better, they're far more productive, they have less driver turnover, more driver satisfaction. But drivers at their very core love predictability. Predictability in routes, start times, day of week of day, home time, all those sorts of things. Even when it turns out, in terms of the freight they haul, they love to haul the same type of freight with the same customers. So there is a lot to be said for time-based, annual salaries. It's a model that works brilliantly in Europe. Their working time directive allows for drivers to run less hours than we do a day. I think it's something like 9 hours a day. But on an annual salary, the whole issue of dock time and waiting time changes the way drivers behave. You have much better safety outcomes when drivers aren't paid per mile and have to rush accordingly. And I remember one of my first consulting jobs here, one of the things we did with a fleet, a gasoline tanker fleet who had a pretty high accident rate and were uninsurable, they were paying drivers by the load. And one of my first pieces of advice was switch to hourly as quick as you can and take the pressure off drivers, because you're trying to cram 14 hours of dispatch into a 12-hour window. Bad things are going to happen. That's just how it works. As soon as we switched to 12 hours a day, hourly pay, accidents dropped and drivers became less stressed and more happy, and guess what? More productive.
One more point that you had about sort of dock time being a real killer. Is there anything that shippers can do? I know that shippers are probably going to be interested in trying to reduce the amount that they're having to pay. And I assume that having docks be cleaner, easier to use, and just generally making sure that the turnaround is as fast as possible is one way to kind of forestall having to pay your brokers more.
I think there's two things shippers should be doing and doing a lot more of, and that is offering, providing more capacity over a 7-day week. There's a lot of, sort of capacity on weekends that doesn't get utilized. So shippers should be looking at a wider dispatch and receiving window. But the other thing, the most important thing, is get trucks off your dock quickly, get those trailers unloaded as fast as you can. We saw reports last week of a large truckload carrier that's got 30% of their trailers unavailable because they're loaded and can't get unloaded. But drivers want to drive. They cannot stand sitting on a dock waiting and not being paid. I remember at one fleet we looked at the voluntary termination rate. And it was as high as it went up like about 70% between 0 and an hour and 29 minutes. So there was this voluntary turnover rate that increased exponentially up to an hour and 29 minutes. So why would a driver quit in a sort of an escalating rate up until an hour and 29? Well, and then it dropped away at an hour and 30. Well, it was because they got paid detention pay at an hour and 30. Because drivers cannot stand waiting on a dock. And the worst possible thing that can happen is the doors close at an hour and 29 minutes. And that green light goes on, and you've sat for an hour and a half, and that's why you see wait time correlates to hard brake events and accidents. It's easy to connect the dots psychologically with what goes on. But driver frustration is a big part of it. Shippers can do a lot more in terms of getting drivers on and off docks, treating them with respect, providing the right sorts of facilities, and the list goes on.
Is there a way that brokers and dispatchers can help to encourage shippers to behave themselves?
That's a tough one.
Yeah.
More communication would be good, but
level setting expectations too, right? If someone calls at 3:00 on a Friday and they're like, I need this picked up and delivered a 400-mile run, and I need it delivered at 3:00 on Sunday, or if your shipper wants, if the straight through delivery time is Sunday at 11 p.m. and the first delivery appointment is until Monday at 8 a.m., that's a problem.
Yeah.
Right. And much like brokers don't want unexpected detention time, drivers definitely don't want it. So I think understanding all of that, understanding ETAs, doing more than just dividing your total mileage by 45 to get an expected ETA is probably going to pay dividends for both your operation as a broker and your carrier's operation. And that's a huge fallacy. We're going to move on to questions here in a minute because we got a bunch of them stacking up. But I think the biggest fallacy I see among brokers is that they don't have an operation. That they're not in charge of running an operation, and if they do, they classify their call center as the operation. I think if you think like a fleet, like if you think like as a broker, if you could put yourself in the mindset of your carriers that are running an operation, I think that would only be beneficial. I don't think that's going to be time wasted as a broker. Just my 2 cents. And I think that's why, again, I said we were going to move on, but I think that's why a lot of mixed service providers, so ones that have assets and non-assets, do a really good job on the non-asset side of contemplating some of these things, because they have a lot of cross-pollination between the asset side of their house and the non-asset side.
Yeah, I assume that when you're in a non-asset-based area, that a lot of the labor is kind of invisible, and that can cause a lot of heartache and a lot of frustration.
For sure. All right, Ned, you want to hit us with some questions?
Absolutely. Matt Clark asks, Ken, did the big fish get away last week?
So the bummer of all of it is trout like cool, clear water, and it's been in the high 80s to low 90s here. So basically we saw a bunch of fish with our polarized sunglasses just looking at us. I know that they were having a good time. I mean, the good news is every time I reached into the cooler, I caught a beer. So I was batting 1,000. I was batting 1,000 when it came to that. I did forget my koozie one day, so my hand was cold, but I think that's a first world problem.
That's why they call it fishing and not catching.
Exactly.
All right, Stephen from Blue Grace asks, is there any good data source on the truck fulfillment of Class 8 truck orders? I understand there have been disruptions in manufacturing because of semiconductor shortages, and wanted to see how they've impacted Class 8 orders.
That's a Jason Miller question. I mean, anecdotally, anything that's ordered now and pretty much anything that was ordered most of this quarter is not going to hit in 21 unless you've heard differently, Dean.
No, anything I heard was from ACT Research. They were talking about the order books for 2022 hadn't opened up yet. I don't know if that's changed in the last week, but I suspect we'll know how good the appetite is for buying and ordering new trucks once the order books open up for next year.
Elisha asks, with the salary increases, do you expect the current rates to become the norm, and what would it take for rates to get back to normal, or what we have thought as normal last year? Or I would assume prior to last year, but like back to those halcyon days of 2019. I mean,
I'm rereading the question. Sorry.
Yeah.
I mean, spot rates and driver pay are pretty much they're unrelated. The spot market is unbounded. So the best way to think about this is a stock price necessarily tied to that company's earnings? I mean, the answer is no. I mean, maybe 100 years ago. But anymore, the biggest and most powerful companies in the world, some of them don't even turn a profit. So, I mean, A lot of that is based on sentiment. It's based on prevailing market conditions. It's based on how well you negotiate. I think on the contract side, though, that will tie back to those driver pay increases, because there's only one of two things that can happen. Either operating ratios of asset-based fleets will suffer, or they will pass along. And it's not like if there will be there's gray in this equation. So they'll either pass along that driver pay increase to the shipper, all or part of it, or whatever they don't pass along will erode away their operating margins.
Yep.
Or I guess the third option is they can claw it back from their drivers. They'll see a spike in turnover, and it will roundabout impact their operating ratio. But there's no free lunch once you've started paying your folks more.
Yeah, no, it's just math. And I mean, one of the things that's really rough about this from like a broad industry standpoint is that exactly what Ken said. Once you can't really pass along to shippers, it's going to eat away your OR, and as that gets bad, you might get out competed by other companies that are able to just operate better, and then you kind of get that weird roundabout in a side doorway. Anyway,
yeah.
Aaron asks, are there any signs that the increased adoption of digital freight matching technology for truckloads is adding to market disruption?
These are three very well sequenced questions. I will say, and then I'll turn it over to Ned and Dean just to kind of get my quick 2 cents in. What you are seeing is evidence of reduced frictions in the market and increased transparency. Things moving faster isn't happenstance. It's the information is flowing faster, whether that be digital freight matching, digital brokerages, increased availability of content, people having more free time at home to read and investigate and things like that. I know at DAT we've put more data available out. We used to just have trend lines, which was a static web page updated once a week. We now have free data available on the Snowflake marketplace that people can go query and get a pretty good idea of what's happening, even if you're not in a seat, right? You're not moving freight or dispatching. So definitely we are seeing a reduction in friction to market changes and an increase in transparency. But what do you guys think?
I mean, I largely agree with you. I mean, to Dean's point earlier about detention, like if you're an owner operator, finding your next load is effectively this unpaid time, right? And the longer and the harder it is to find what your next load is, the rougher it's going to be. And then from the larger operators, again, like you're not being paid to find loads. You are kind of in the sense of opportunity cost, but the degree to which more transparency and more information can be provided, you are getting paid more for doing what you do well. And so I think that it's overall kind of helpful, but it's also going to, I mean, when people have more ability to get back slightly to the question, when people have more ability to search and be choosy, the markets do change, and it's just an issue of getting used to the new normal. In some senses. Yeah.
I think it's also fast-tracked the learning curve for a lot of smaller fleets. The transparency that's offered from our, the DAT1 app and our load boards. You've got carriers. A friend of mine bought a truck a little while ago, and he didn't know I worked at DAT at the time. And I said, so how do you know where all the freight is? And he pulled out this app and he showed me this load board, which of course we recognize as our load board. And he said, I can find any amount of loads I want here. I know where the freight's moving. I know what the rates are. And he was running for like $4 a mile at the time. And of course, freight volumes have quietened down. And I did catch up with him last weekend. And I said, so what have you been doing? And he said, I've just been to the West Coast and back for $18,000. And I said, wow. And he said, there's so much freight out there and the rates are so good. So again, there's a guy from New England who has complete visibility into the entire freight market and can run sort of, record level miles and productivity at the same time through a digital, application.
Warms the cockles of the heart. Trifecta Transport asks, I've noticed a spike in rates coming out of South Carolina and North Carolina back up to the Midwest region. What do you think has caused this drastic spike?
I'll take a rough guess at that. I'll have to look into that and maybe get back next week. But it's produce season is, pretty big down there in that part of the world. So if dry van capacity is tight, you'll find a lot of those reefer carriers will be under temperature controlled loads. So a lot of that capacity migrates over to that sector. You've got a lot of volume coming into, Charleston, Savannah, ports at the moment. So that's going to, offer a lot more volume. But if it's refrigerated, it's an easy one. It's produce season. It starts down there. It started early April with Vidalia onions, and we've got peaches coming online. All sorts of wonderful goodies coming out of that part of the world.
Jared asked, what program certification as a future analyst do you have in order to learn more about freight analytics? That's a toughie.
So, I mean, there's some really great academic programs. I know Michigan State has a really great program. You can reach out to Dr. Chris Kaplis, who runs the Center for Transportation and Logistics at MIT. Most folks I know bootstrapped it, though, right, Ned?
Yeah, absolutely. You know, I came in from Homeland, and I had a lot to learn, but it's a really interesting space.
I have a finance degree from a state school.
Yeah,
and I cut my teeth at the power company. So, yeah, I mean, I think a lot of this, it's a lot of similar concepts, though, right? Time series, forecasting, segmentation analysis. It transcends whether you're breaking steel mills and data centers out into different segments for power consumption, or you're looking at produce haulers versus heavy industrial flatbed haulers in the transportation market. I think the key principles of good analytics, as long as you're curious and you have access to good data, that's the number one thing. I mean, we are actively recruiting for a number of positions given our growth, and I don't care how good your resume is. If you're not curious in an interview, you're out. So that would be the number one thing I think that I would highly encourage you to think about.
If you are in the freight, can we do two more really quick? Also, I would say if you are in the freight analytics space and you are interested in working for this fine organization, I would strongly recommend you apply. We have a number of open positions, and we'd love to have you.
And by number, he means dozens of open positions. Our growth, we're spread across 2 offices. We have a headquarters in Denver, Colorado, and Portland, Oregon. We have remote opportunities. Actually, we're spread across more. Right? We have sub offices in India and all. I don't know where, Missouri somewhere. Yeah. There's also one somewhere else. I just don't know. Great DAT employee here. Yes. Our geographic footprint is just so massive that I lose track of it. But yeah,
Brenda
go ahead.
asks,
Check out our career page, please.
Yes. Brenda asks, I have to do an RFP at the end of the month. I want to remain competitive with the market. Do I quote for the year at the current market?
No, do not do that. Whatever you do, do not do that. AskIQ@DAT.com. Send us the RFP. We will run it through RateCast, our predictive rating algorithm, for you for free. No questions asked, no strings attached. AskIQ@DAT.com. We'll get you a 12-month projection of what spot rates are going to do in the lanes that you're interested in. The caveat being, if it's 10,000 lanes, I don't know. I might have to eat my own words here, but presuming it's just a few hundred lanes or a few dozen lanes, we're happy to run that through RateCast for you. And that will essentially give you the forward looking. Now is probably the worst time in the past 40 years to be using prior year or current market as your assumption for RFP response.
Unfortunately.
Well, fortunately, because RateCast exists and it's awesome. It's 96% accurate. With the multi-lane download functionality, if you have RateView and you have RateCast, you can upload your RFP in the same process, and it'll give you all 12 months of predictions for all 3 equipment types for spot.
And then I know that we were hoping to do long-term predictions this week. That might happen next week. We can show some graphs to give some more information, although that probably can't wait for next week. Final question is very important. Monica says, hello. Good morning, boys. The show popped up in my feed today. Miss you all. Great content as always. Monica G.
Our former producer.
Yeah.
Enjoying early retirement, or whatever she's up to nowadays. But thanks for checking out the show, Monica. All right, I'm going to wrap us up for this week. We're running long. I want to thank everyone. This was a ton of really great questions. We'd love to sit here and answer even more of them, but we're getting the hook here. Check out Dean's weekly market update. We have a ton of great content posted recently. Kudos to our content team. I saw a white paper, I think it was Walmart, a few other customer use cases I think you'd find very interesting. Go ahead and check those out on our website. Chris Kaplis' Freight Find podcast. Always a wealth of really great information and great conversation and insight. And with that, we'll be back here next Tuesday at 10 Eastern, 7 Pacific. If you have any questions in the meantime, askiq@dat.com. All right. Have a great week, everyone.
Okay.
Try to stay cool.